Hello, friends. So today we are here to revise the last part of my chapter, assessment of various entities. If you remember, in the last class, we did first part of this chapter where we covered different types of company, the domestic company, foreign company, Indian company, what is the meaning of all these companies, and classification of companies like the closely held company or the widely held company. Okay. Then we discuss about the tax rate applicable to the companies, the concessional tax regime, the MAT rate, and provision relating to the taxation of firms or LLPs. Right. So hope this was clear to you. Now in today's class, we'll do the rest of the chapter. Okay. So we'll start with the cooperative societies. So we'll do the tax implication in respect of other entities. So if you understand, there's a definition of the term person. Person. It includes company, which we discussed in the last class. Firm, including LLP. In today's class, we will discuss about cooperative society, individual, HUF, AOP, BOI, etc. HUF, AOP oblique BOI, local authority. And lastly, we will discuss about the fitness test key. Okay. So let's start with cooperative society. So for the cooperative society, as similar to the company or individual, there are two tax regimes. So if you remember, except for the partnership firm and the LLP, every entity has a two tax regime. Old tax regime, where the tax rates are high, but the entity, the cess is eligible for the exemption and deduction. And the new tax regime, where the exemption deductions are not available, but tax rates are concessional. Okay. So we'll first discuss about the old tax regime applicable to the cooperative society. So the tax rate applicable to the cooperative society in case of old tax regime is if the total income is up to rupees 10,000, then the tax rate is 10%. If total income exceeds 10,000 but does not exceed 20,000, the tax rate is 20%. If the total income exceeds 20,000, the tax rate is 30%. So as similar to the individual, there is a slab rate applicable for cooperative society as well. But with a one fine line difference, there is no basic exemption limit in case of cooperative society, as is there in case of individual, HUF, etc. So even if there is 1 rupee income, such income shall be taxable at the rate of 10%. Though there is a slab rate, but there is no basic exemption limit. So any income up to 10,000 is taxable at 10%. Above 10,000, up to 20,000, 20%, and beyond 20,000, 30%. Okay, so 10, 20, 30. Simple tax rates in respect of income of 10,000, 20,000, more than 20,000. Okay, the corporate society is also subject to surcharge. The surcharge rate is similar to the rate applicable to domestic company. That is 7% of the income tax if total income exceeds rupees 1 crore, and 12% of the income tax if total income exceeds rupees 10 crore. Okay. So if the income is up to 1 crore, no surcharge. If income exceeds 1 crore but is less than 10 crore, then 7%. And if the income exceeds 10 crore, then the 12%. The surcharge is it 7% and 12%. As you know, wherever there is surcharge, there is marginal relief available. Okay. So this was all about the old tax rate applicable to the cooperative society under the old regime. So what are tax rate? If the total income up to 10,000, 10%, 10,000, 20,000, 20%, beyond 20,000, 30%. Surcharge, if the total income exceeds rupees 1 crore, then the 7%. But if total income exceeds 10 crore, then 12%. Okay. Of course, this income tax and surcharge shall be increased by the education cess of 4%. Okay, so this was pretty much easy. Now we are discussing the concessional tax rate applicable to the cooperative society. This is a new tax regime. So as we discussed in case of company, the similar regimes are applicable for cooperative societies as well. So firstly, a benefit is given as identical to the identical similar to the companies to cooperative society engaged in manufacturing or production of an article or thing or generation of electricity. Okay? But this benefit is given only if the cooperative society is resident in India. Section, relevant section 115 BAE. If you remember, there the section was 115 BAB. Okay. So what this section says, this section will say, if a cooperative society is incorporated on or after 1st April 2023 and it commences manufacture or production of article or thing on or before 31st March 2024, then the cooperative society has an option, so it's an optional fee, has an option to opt for this concessional tax rate and pay the tax at the rate of 15% on the income arising from this manufacturing and production of article thing or from the generation of electricity. So clear? Similar to the company, who is the eligible assessee? The corporate society who is resident in India. The corporate society should be engaged in manufacture or production of article or thing or generation of electricity. Okay. The corporate society should be new. It means it should have incorporated on or after 1st April 2023. Okay. But the manufacturing or production should commence on or before 31st March 2024. Okay. So there is only a 1 year window by which to claim this 115 BAE concession tax at 15%. So if you satisfy this condition, you are a resident corporate society, you are engaged in manufacture, production of article thing or generation of electricity, and you are incorporated or registered on or after 1st April 2023, but before, and you commence the manufacturing or production of article thing or generation of electricity on or before 31st March 2024. If you satisfy this condition, then you can, it's an option, you can opt for this concessional tax rate of 15% on your income from this manufacturing activity or from income from this activity of generation of electricity. Okay, clear? Okay. But as in case of companies, there is a mandatory surcharge under the scheme at the rate of 10%. Okay. So irrespective of the amount of income, whatever the income there is, the income shall be increased by surcharge at the rate of 10%. So the tax rate of 15%, increased by surcharge of 10%, and there of course there's a cess of 4%. Okay. So what is it? Who is eligible? Cooperative society resident in India engaged in manufacturing or generation of electricity. The tax rate is 15%. Surcharge mandatory 10%. MAT or AMT as the case may be. So AMT is not applicable if you opt for this concessional tax rate. So if there is any AMT credit on the date of opting, then this shall lapse. Okay, this is an academic thing, because if you are incorporated after April 23 and you have commenced the operation before 31st March 24, then this must be your first year. Okay. So this concessional tax rate of 15% is applicable only in respect of income from manufacturing or production of article or thing or generation of electricity. Okay. If you have any, you mean the corporate society have any other income, then such other income shall be taxable as below. So if the income is taxable at a special rate provided under the Act, say long-term capital gain or short-term capital gain of section 111A, etc., then such income shall be taxable at such specific rate. If there is no such specific rate, then such income shall be taxable at 20% on gross basis. So the other income other than manufacturing or production generation of electricity shall be taxable at 22% other than the special income and on gross basis without allowing the deduction. Okay. And if there is a short-term capital gain on transfer of a capital asset on which depreciation is not claimed, then the short-term capital gain shall also be taxed at the rate of 22%, but after allowing the deduction of as allowed under the head capital gain. Okay, so you understood? First, the concessional tax rate of 15% is applicable only qua income from manufacturing, production of article or thing or generation of electricity. Okay, the other than these income, if there is any special income which is chargeable to special rate of tax, such income shall continue to be taxed at such rate of tax. Apart from all these two types of income, all other income shall be taxable by 22%. The short-term capital gain shall be taxable by 22%. Any other income shall be taxable by 22% on gross basis. Okay. So all this 15%, 22% shall be increased by surcharge of 10% and cess of 4%. So what are the conditions? The cooperative society is set up and registered on or after 1st April 23. So this section was introduced with effect from 1st April 23 to give a similar benefit to the cooperative societies as is given to the domestic companies. Okay. The society is engaged in any business or manufacture or production of article or thing and research in relation to distribution of such article or thing or business of generation electricity. Okay. So the only those cooperative societies who are either engaging in manufacture production of article or thing or generation of electricity are eligible for this benefit. Okay. Refer note 2. Note 2 says that following 5 activities are not considered as manufacture production of article 3. One is development of computer software, then mining, then transfer of marbles into slab, then printing of books, and then fourth one is bottling of gas into cylinders, and lastly any other business as may notified by the central government. So if cooperative societies engage in any of these businesses, then it is not eligible for the benefit of Section 115 BAE concessional tax rate of 15%. So what? These businesses are not treated as a manufacture production of article or thing. What? One is development of computer software, second mining, third is conversion of marble block into slabs, then bottling of gas into cylinders, and lastly printing of books or production of films. These 5 businesses are not considered as business of manufacture or production of article or thing, and therefore any cooperative society engaged in any of this business is not eligible for concessional tax rate of 15% under Section 115 BAE. Clear? Such manufacture production is commenced on or before 31st March 2024. Okay, so this should commence before 1st April 2024. Since this is a concessional benefit and it is intended to be given to new cooperative societies, so law has imposed condition to ensure that benefit is given only to the new cooperative society and not to the reconstituted cooperative society already in place. So it says that the SSC should not be formed by splitting up of an existing business. So it should not happen that with an existing cooperative society and it split up its business and form another cooperative society only for the sake of taking this concessional tax rate of 15%. The government wants to give this benefit only to the new cooperative society, to the new businesses, okay? To new manufacturing entities. And similarly, it is not formed by transferring old machine. So if the entity is formed by splitting up of existing business, then it is not eligible for the benefit. Or if it's the plant and if it is using old plant and machinery, then also it's not eligible for the benefit. But old plant and machinery does not include plant and machinery used outside India by any other person, which has been imported into India and in respect of which no depreciation has been claimed under this act before the date of its installation. Okay. So what does it mean? It means old imported machines are allowed. So if you are importing machine from outside of India, which was used outside of India, such machine shall not be considered old machine. This is one. Secondly, a benefit is given up to 20%. So out of the total plant and machinery installed by the cooperative society, if the old plant and machinery are up to 20%, then the benefit is allowed. But if the old plant and machinery exceed 20%, then this benefit shall not be allowed. And for considering what is old plant and machinery, the machinery which is imported into India, though was used outside India, and it's an old machinery imported into India, is not considered as old plant and machinery. Income, of course, income is computed without allowing some exemption or deduction. Yeah. But if in any year you compute the income by applying, you compute the income otherwise, then this benefit shall be foregone for that year and for the subsequent years. Okay. This option has to be exercised in the first year itself, in the first year of the cooperative society. If it is not exercised in the first year, then it cannot be exercised subsequently. That's all. But if you have exercised this in the first year, then you will continue with this benefit. Okay. Option 1 exercise cannot be subsequently withdrawn. So if you have once exercised for this concessional tax rate, you continue with this. It cannot be subsequently withdrawn. Okay. Now, provision section 80IA10. What is that? So what happened is that since there is a person who has this cooperative society which is eligible for concessional tax rate of 15% under section 115 BAE. Here, some other entity also doing the business. Now and that entity will be taxable normally at higher rate. Okay. So what he does is that he transacts between these two entities of its own in a way that the profit in the cooperative society, this concessional rate of cooperative society, the society which is eligible for concessional rate, the profit in this cooperative society is more than the reasonable. Okay. Why he will do that? Because if there's a higher profit in this cooperative society, then that higher profit shall be taxable at a concessional tax rate of 15%. And if there's a higher profit, it means there's a higher cost in the other entity, which is taxable at a higher rate. So in a way, it takes the advantage of concessional tax rate, even on income not accruing to this cooperative society. Okay. So it says if such is the case, then specified domestic transaction provision, specified domestic transfer pricing provision shall applicable to this transaction. And if tax officer finds that there is any such income, then that additional income shall be taxable in the hand of corporate society at the rate of 30%. Okay. And if the corporate society has opted for this section, then whatever the income is, it will be increased by the surcharge of 10% along with the cess of 4%. Okay. So let's see what are all deduction and exemption which are not available to the cooperative society opting for section 115 BAE, concessional tax of 15%. So similar to the company, addition depreciation is not allowed, investment allowance section 32 AD not allowed, 33 AB and ABA not allowed. So it's exactly similar to the company which we discussed in the last class. Donation given, scientific donations given by the company in section 35 is not allowed, or for expenditure in respect of in-house research. Section 35 AD or 35 CCC is not allowed. Then direction chapter 6A, except 80 JJAA and 80 LA IFSC is not allowed. Or any loss of brought forward depreciation on account of above deductions shall not be allowed and shall be deemed that they have been allowed. Okay, which they cannot be carried forward. Total income is computed by claiming depreciation under section 32, determined in such manner as may be prescribed. It means the maximum rate of depreciation allowed to the cooperative society opting for this section is 40%. Okay. So this all are similar to what we discussed in case of companies. Okay. So what does section 115 BAE says? It is applicable to cooperative society which is resident in India, one, which is engaged in either manufacturing or production of article or thing, or generation of electricity. Okay. Then such cooperative societies may opt for, it's an optional, this concessional tax regime. Here the income from this manufacturing activity or generation of electricity shall be taxable at a concessional tax rate of 15%. Okay. Any other income, if such income is taxable at a special rate, then we'll taxable at that special rate. Otherwise, it shall be taxable at 22% gross basis except short-term capital gain on transfer of capital asset on which depreciation is not claimed. Okay. So whatever the rate given this section has to be increased by surcharge of 10% irrespective of the amount of income. Okay. So the corporate society to opt for this should be registered on or after 1 April 2023. That is, it should be new. It should commence the manufacture before on or before 31st March 2024. It should not be formed by splitting up of the existing business, and it should not use the old plant and machinery. Okay. But the machinery imported from outside India in respect of its depreciation has not been claimed under this act is not considered as old. Secondly, 20% of old plant and machinery is allowed. Okay. Then these 5 businesses are not considered as business of manufacture, production of article or thing. Meaning thereby, if the corporate society is engaged in any of this business, then it is not eligible for 115BA. 1. Development of computer software, mining, then conversion of blocks into slabs. Then fourth one is printing of books or production of films. And lastly, the fifth one is bottling of gas into cylinders. Okay. Income has to be computed without the exemption or reduction as specified in this section, which is similar to what we discussed in case of company. The option has to be exercised on or before the duty of return of income of the first year of the corporate society. So it's very important. This option should be exercised on the first year. Once exercised, each cannot be withdrawn subsequently, it shall continue. Okay. If there is a transaction between this corporate society and any other associated entity, then the provision of domestic transfer pricing shall be applicable. If there is any addition on account of that, then such addition shall be taxable at the rate of 30%. Okay. So this was all about the concessional tax regime applicable to corporate society engaged in manufacturing or generation of electricity. Okay. Now, similar to the companies, there is a new tax regime. So a corporate society, whether new, whether old, whether engaged in manufacturing or not, is relevant, can either opt for the old tax regime, which we discussed in the starting, 10,000, 20,000, 10%, 20%, 30%, or it can opt for section 115 BAD concessional tax regime. Here, the corporate benefit is given only to the corporate society which is resident in India. The concession tax rate is 22%, but it shall be increased by surcharge of 10%, irrespective of the amount of the income. Okay. Both as in 115 BAE, AMT is not applicable. The tax rate is 22%, but if there is any special income, like which is taxable at a special rate, like 112A, 112, 111A, etc., within from lottery, such income shall be taxable at such rate only. All other income shall be taxable at that 22%. Whatever the tax shall be increased by the surcharge of 10% and cess of 4%. Okay. Then there is no condition. The publicity may be old or existing or new, or may be engaged in manufacturing or may not be engaged in manufacturing. All corporate societies are eligible for this benefit. Remember, see, if you are a corporate society which was eligible for 115 BAE, that 15% concessional tax rate, and if you not opt for such a rate in the first year, then you can opt for 115 BAD, this 22% rate. Okay. So this 22% rate is available to the all corporate society. Only condition is it should be resident in India. No other condition. Similar to 115 BAE, the income is computed without allowing some exemption deduction, as we discussed. So this is the core of the new scheme. The income is computed without some exemption deduction, and the tax rate is concessional. This option has to be considered on or before the duty of furnishing return of income under section 139(1). And one exercise we shall apply to subsequent years, and you cannot be withdrawn. Okay. So these are the deductions which are not allowed if the corporate society is opting for 115 BAD or 115 BAE. This we discuss what do you mean by old plant and machinery. So in case of 115 BAE, concessional tax rate of 15%, one of the conditions is that you should not use, means the corporate society should not use the old plant and machinery. But if the plant and machinery is imported, then it's not considered old. So it says any plant and machinery which was used outside India by any person other than the assessee shall not be regarded as old machinery. It shall not be regarded as old machinery if such machinery was never earlier used in India. Such machinery is imported into India from any country outside India. And lastly, no depreciation in respect of such plant or machinery has been allowed under this Act, under the Act Income Tax Act 1961, in computing total income of any person for any period prior to a date of installation of such plant and machinery by the assessee. Okay. So, if your machinery is imported, even though old, no issue. And lastly, we discuss in this respect only, where the total value of old machinery does not exceed 20% of the total value of the plant and machinery used by the cooperative society, then the condition specified that the cooperative society should not use any machinery previously used for any other purpose to be deemed to have been complied with. So, leeway of 20% is allowed. You can use old machinery up to 20% of your total plant and machinery. Okay. So this was all up to in respect of cooperative society. We discussed the old tax regime. We discussed the new concessional tax regime. One, the benefit given to the new cooperative societies engaging manufacturing, production of article of thing or generation of electricity. The benefit is the concessional tax of 15%. And secondly, we discussed the new regime under section 105 BAD, where the tax rate is concessional, which is 22%. Okay. Now, let's discuss one or two questions from this topic. So, question says transfer fees are received by cooperative housing society from its incoming and outgoing members. Are such transfer fee liable to tax in the hands of cooperative society? What the cooperative society is doing? Receiving the transfer fee from its member, whether they are incoming or they are outgoing. If they are joining the cooperative society is charging the transfer fee. If they are leaving the cooperative society, they are again charging transfer fee. If they are transferring their membership to some other person, then transfer fee is charged. Okay. The question comes about the taxability of such transfer fee. So, if you know, there is a concept of mutuality, which we discuss in detail in today's class only. So, the code said, if you're dealing only with your members, you're earning from them, you're spending on them, then there is no income. So on this issue, this issue came in before the High Court in the case of Sindh Cooperative Housing Society. The court observed that under the bylaw of housing, charging transfer fee had no trading or commerciality. So this charging of transfer fee had no commercial element. Okay. The High Court held that transfer fee received by cooperative housing society is not liable to tax on account of principle of mutuality. So mutuality means you're dealing with yourself. So but the court held that cooperative society is member of one and the same thing. They are dealing with their own self, and therefore no one can generate income by dealing from its own self. Okay. So this was all about the cooperative societies. Now we are moving to another types of entity, which is individual, HUF, AOP, BOI. So similar to company or cooperative society, these persons are also eligible for both the scheme, old regime and the new regime. The new regime being the default tax regime. So if you don't opt for any of the regime, you will be taxed under the new regime. Okay. So what are slab rates applicable in the new regime? So under the new regime, the slab rate is there is no tax up to rupees 4 lakh. And on every additional 4 lakh of income, the tax rate is charged from 5% and it keeps on increasing by 5%. So if your total income is up to 4 lakh, no tax. If your total income is exceeds 4 lakh but up to 8 lakh, 5%. Exceeds 8 lakh up to 12 lakh, 10%. 12 to 16, 15%. 16 to 20, 20%. 20 to 24, 25%. And any income more than 24, 30%. So 30%, the highest tax rate kicks in when your total income exceeds 24 lakh rupees. Okay. They as per the new tax regime, default tax regime. So basic exemption limit in the new regime is 4 lakh. And on every increase of income by 4 lakh, there is an increase in tax rate by 5%. So 4 to 8, 5, 8 to 12, 10, 12 to 16, 15, 16 to 20, 20, 20 to 24, 25, and beyond 24, 30%. Okay. Now, there is a concept of rebate which is applicable only in case of individual. The above slab rate is applicable for individual, HUF, AOP, BOI, or artificial judicial person. But the benefit of rebate is applicable only to the individual, and that to resident in India. So our resident individual has a total income up to rupees 12 lakh. Then he is eligible for a rebate from the income tax. The rebate is computed from the income tax liability. Is deducted from the income tax liability, not from the income. So what is the amount of rebate? 100% of such liability, income tax liability, or rupees 60,000, whichever is less. So the maximum rebate is 60,000. What is the 60,000? This is a tax on rupees 12 lakh. Okay. So if your total income is up to 12 lakh, then under the new regime, there is no tax if there is no special income. What do you mean by special income? I mean, the law says the rebate is applicable only in respect of tax computed in section 115 BAC, this new regime. So if the tax is computed under any other section, say 112, 111A, 112A, etc., then rebate is not applicable on such special income which is taxable at a special rate provided under the Act itself. Okay. So rebate is not available against income chargeable at special rate. Example 11A, 112, winning from lottery, etc. One more thing. Here, in the default tax regime, the marginal rebate is available even in case of rebate. Okay. Now surcharge. So we understand the tax rate. Then, in addition to tax rate, there is a new concept of rebate. And who is eligible for rebate? You should be individual, resident, and total income should be up to rupees 12 lakh. Then you are eligible for rebate of 100% of the income tax or rupees 60,000, whichever is lower. But the important point is rebate is not allowed from special income. So if you have a normal income of 12 lakh, no tax liability. But if you have a special income, say of 10 lakh, then there will be a tax liability because you will not be eligible for rebate on your special income. Okay. Now the surcharge. So the surcharge is applicable if the total income exceeds rupees 50 lakhs. So no surcharge if the total income is up to 50 lakh. If the total income exceeds 50 lakh, there is surcharge of 10%, but up to rupees 1 crore. If the total income exceeds 1 crore, then surcharge rate increased to 15%. But if total income exceeds 2 crore, then the surcharge rate increase to 25%. Okay. So up to 50 lakh, no surcharge. 50 lakh to 1 crore, 10%. 1 crore to 2 crore, 15%. Beyond 2 crore, 25%. So under the new tax regime, the default tax regime, the highest rate of surcharge applicable is 25%. Okay. Beyond 25%, there is no surcharge. Only three steps. Up to 50 lakh nil, 50 lakh to 1 crore, 10%, 10 crore, 2 crore, 15%, beyond 2 crore, 25%. Okay. But also, as you all might know, the maximum rate of surcharge on long-term capital gain or dividend income cannot exceed 15%. The maximum rate of surcharge cannot exceed 15% in respect of income from long-term capital gain or dividend income. And if the other income is more than 2 crore because of these type of income, then the surcharge rate on other income shall also be restricted to 15%. If other income without this three special income, which is dividend, 111A short-term capital gain or long-term capital gain. If other income without these special income is more than 2 crore, then the surcharge rate on that other income is 22%, 25%. But surcharge rate on these income shall always be limited to 15%, cannot exceed 15%. Okay. Similar, as we know, there is a benefit of marginal relief whenever there is a surcharge. But under new tax regime, there is a concessional tax rate. But if there is a concessional tax rate, then the government will not allow you some exemption or deduction. Okay. So what are all exemption deduction which are not allowed under the new tax regime? LTC under section 10(5) or house rent allowance under section 10(13)(a). Then allowance under section 10(14) except the traveling, conveyance or daily allowance. This is a transport allowance which is actually allowed to handicapped, blind or deaf and dumb. Exemption provided in respect of free food or non-alcoholic beverages to the employee is not available under the new tax regime. Then section 10(17) goes to the MLA or 10(32), which is a exemption given in case of clubbing of income of minor child. This exemption under section 10 is not available if you are computing income under section under the new regime. Section 10AA, the SEZ deduction. Then section 16, the deduction that had salary. But one deduction is allowed, which is standard deduction, and that too at an increased amount of 75,000. So if you're opting for old regime, the standard deduction is allowed up to 50,000. But if you're opting for the new regime, the standard deduction is allowed up to rupees 75,000. But the other two deductions, professional tax and entertainment allowance, is not allowed under the new regime. Then, if there is a loss on account of self-occupied house property, such loss is not allowed. Additional depreciation is not allowed. That's similar to the cooperative societies. Any scientific donation or scientific research expenditure in-house research is not allowed. Section 35 AD is not allowed. Deduction under Chapter 6A are not allowed except employer contribution to NPS or employer contribution to Agnipath scheme or section 80JJAA or 80LA AFSA. Any other exemption or deduction for allowance of perquisite by whatever name called, provided under any other law for the time being in force, is not allowed. Say there's a law which says that some allowances given to the judges of High Court and Supreme Court shall not be subject to income tax. So such exemption is available only under the old regime. It shall not be available under the new regime. Okay. Then if there's a loss under house property, see, loss under house property from the self-occupied property is not allowed earlier only. But if there's a loss under house property means this loss is on account of let out property. Then such loss cannot set off against any other income under any other head. Okay, it can be set off only against income under that house property. Any brought forward losses or earners of depreciation pertaining to these deductions shall not be allowed to be set off or carried forward, and they shall be deemed that they have been allowed. So they shall lapse. Okay. Now, these are the exemption or deduction which was not applicable, which are not applicable in case an employee opt for the new tax regime. Okay. But so these exemption deduction are not available, so total income will be more if you opt for the new regime. But there are some benefit if you opt for the new regime. So this was the losses. So this was the denial of the exemption. But there are exemption more than what is actually allowed in the old regime. What are the exemption? One is we discussed standard deduction under the head salary is allowed 75,000, while in old it's allowed only 50,000. If you have a family pension, the maximum deduction is allowed 25,000. However, in old it is 15,000. Then lastly, under section 80 CCD2, employer contribution to NPS, the deduction is allowed up to 14% of the salary if the employee opt for the new tax regime. However, if employee opt for the old tax regime, then the deduction is allowed up to 10%. So these three are actually the benefits of the new tax regime. And other was the denial of the exemption deduction under the new tax regime. Of course, if the individual HUF, AOP, BOF, artificial judicial person opt for this concessional rate under section 115BAC, then he is not liable for the AMT, and any brought forward AMT credit shall lapse. So what the simple tax planning is, if you have an AMT credit, you first utilize it. Once you have utilized it, then you opt for this new tax regime. So this is a small chart which will help you to remember What all exemption and deduction are not allowed under the new regime, which is otherwise allowed under the old regime. So we have prepared this chart on the basis of head of income. So under the head salary, under the old regime, there is LTC, which is not allowed under the new regime. HRA, which is not allowed under the new regime. Allowance in section 1014, not allowed except the 4 allowances. The 3 one are similar: traveling, daily, and conveyance. And the 4th one is transport allowance to the handicap. Okay. Purchase of free food or non-alcoholic beverage provided by the employer. This benefit is not allowed under the new regime. Then section 16 deduction except standard deduction of 75,000. Okay. If I come to house property, then any interest on self-occupied house property is not allowed. If you come to PGBP, then you are not allowed the additional depreciation and scientific donation or expenditure in-house research and development, or section 3580. Then there is no change in capital gain and other source, but in other source, there is an additional deduction allowed on account of family pension. Right? Then for clubbing, if there is a clubbing of income of minor child, then the exemption up to pay 1,500 is allowed in section 1032, which is not there if you opt for the new tax regime. Then set off income under head, loss under house property cannot be set off against income under any other head. Okay. And set off or brought forward losses or earnings of depreciation on account of deduction referred above shall not be allowed to be set off or carried forward. They shall lapse. Under that deduction under section 10AA on account of SCZ is not allowed under the new regime. And similarly, deduction of chapter 6A, except employer contribution to NPS 80cc D2 or employer contribution to Agnipath scheme 80cc H2 or 80JJAA or 80LA. Except this 4 deduction, no other deduction under chapter 6A is allowed under the new regime. Then the exemption of section 1017, which is there available under the old regime but not available under the new regime, or any other exemption on account of perquisite or allowances, which is provided under any other law, is not allowed under the new regime. I give you the example of allowances given to the judges of High Court or Supreme Court. Okay. So this is all about the new tax regime. So we discuss there's a concessional tax rate. The slab rate is concessional. The basic exemption limit is 4 lakh nil. Beyond 4 lakh, but on every increase of income by rupees 4 lakh, the tax rate increased by 5%. So up to 4 lakh nil, 4 to 8, 5%, 8 to 12, 10%, 12 to 16, 15%, 16 to 20, 20%, 20 to 24, 25%, beyond 24, 30%. Clear? So we are concessional slab rate. Then we discuss what all are exemption deduction which are not allowed under the new tax regime. So this is important part. We discuss in notes also, and we discuss with the help of this table headwise. So under the head salary, first LTC, HRA is not allowed. Then allowance in section 1014, the exemption of allowances under section 1014 is not allowed except traveling, daily, conveyance, and transport. Then standard deduction is allowed up to 75,000 and no other deduction under section 16 is allowed. Then house property, interest for self-occupied house property is not allowed. Then PGBP, the additional depreciation or scientific donation or section 35AD is not allowed. Then no change in capital gain or other source. But then in case of clubbing, the exemption section 1032 up to 1,500 is not allowed. Then we come to set off. The loss under house property is not allowed to set off against income under any other head. And the brought forward losses or depreciation on account of pertaining to these exemption deduction is not allowed to be set off or carried forward. Then deduction under chapter 6A or 10AA is not allowed except 80cc D2, CCH2, 80JJAA, and 80LA. Then the allowances given to the MP or MLAs which are otherwise exempt under section 1017 is not available, the exemption is not available if you opt for new tax regime. And if any other exemption is given in respect of particular allowances under any other law, then such exemption is not available if the assessee opts for the new tax regime. Okay. Then we discuss about the rebate. The rebate is available only in case of resident, individual, total income up to 12 lakh. Rebate is 100% of income tax or 60,000, whichever is less. Okay. The important point is there is a marginal relief available from rebate as well. Then we come to the surcharge. No surcharge if total income is up to 50 lakh. If total income exceeds 50 lakh but up to 1 crore, 10%. More than 1 crore, up to 2 crore, 15%. Beyond 2 crore, 25%. But the maximum surcharge rate on dividend income, long-term capital gain, and short-term capital gain under section 111A cannot exceed 15%. Not only this, if the other income, excluding these income, is less than 2 crore, then the surcharge on such other income should also be restricted to 15%. Okay. So this completes our new tax regime. Now, the old tax regime, which is there. So we have both new and old, and assessee may choose whatever is more beneficial to him. So under the old is applicable in case of individual other than senior citizen or super senior citizen. In case of individual, HUF, AOP, BOI, artificial physical person, no tax up to 2.5 lakh. There it was 4 lakh. From 2.5 lakh to 5 lakh, 5%. And from 5 lakh to 10 lakh, 20%. Beyond 10 lakh, 30%. Okay. The basic exemption limit in case of old is 2.5 lakh, whereas the basic exemption limit in new regime is 4 lakh. Okay. But if you are senior citizen, means you are resident in India and you are of the age of 60 years or more at any time during the previous year, then the basic exemption limit is 3 lakh instead of 2.5 lakh. And if you are super senior citizen, means you are resident in India and you are of the age of 80 years or more at any time during the previous year, then the basic exemption limit is rupees 5 lakh instead of 2.5 lakh. Okay. Here also the rebate is available under the old regime, but similar, the rebate is available only to the resident who is an individual, but here the income should be up to rupees 5 lakh. So rebate is available only if the income is up to 5 lakh. There it was up to 12 lakh. So rebate is equal to the amount of income tax or rupees 12,500, whichever is less. Here the rebate is not available from long-term capital gain referred to in section 112A. There the rebate was not available from any special income. But in the old regime, the rebate is available from all of the special income except long-term capital gain under section 112A. Okay. One more difference, the marginal relief is not available in respect of rebate under the old regime. So if you see, in case of rebate under the old regime, the condition is there should be individual, resident, and total income up to 5 lakh. The first two conditions is same under the new regime as well, individual, resident, but is available up to 12 lakh. If the total income is up to 12 lakh. The marginal relief is not available under the old regime, but marginal relief for rebate is available under the new regime. In case of special income, the rebate is not available under the old regime in respect of income under section 112A, but under the new regime, the rebate is not available in respect of any special income. Okay. So now, surcharge. Surcharge applicable under the old regime. So it's same as in case of new regime, no surcharge up to 50 lakh, from 50 lakh to 1 crore, 10%, 1 crore to 2 crore, 15%, 2 crore to 5 crore, 25%, and beyond 5 crore, 37%. So in case of new regime, the highest surcharge rate was 25%, but in case of old regime, the highest surcharge rate is 37%. So if the assessee has an income more than 5 crore, then in the new regime, the surcharge applicable to him is 25%. But in the new regime, in the old regime, the surcharge applicable to him is 37%. So here also the tax rates are high. The surcharge rates are even high under the old regime, not under tax rates. Okay? And similar, what we discussed in the new regime, the income from dividend short-term capital gain under triple 1A or long-term capital gain. Shall the surcharge on income tax on these income is restricted, this cannot exceed more than 15%. Not only this, if the income other than these income is up to 2 crore, then the surcharge rate is 15%. If income other than these income is more than 2 crore but up to 5 crore, then surcharge rate is 25%. Okay. And if the other income is more than 5 crore, then only the surcharge rate is 37%. Here the marginal relief is available. Okay. So the marginal relief is not available under the old regime, only to a rebate. But in case of surcharge, there is always marginal relief available, no exception. So if you see the surcharge rate, the blue bars are the old regime and the orange bar are the new regime. So to 50 lakh, no surcharge. 50 lakh to 1 crore, 10%, no difference. 1 crore to 2 crore, 15%, again no difference. 2 crore to 5 crore, 25%, no difference. Here comes the difference. If the total income more than 5 crore, then under the old regime, there is a higher surcharge, 37%, while under the new regime, the surcharge rate continues to be 25% only. Okay. Now, what is the rules for the provision in respect of opting for the new regime or the old regime? So first, understand the new regime is a default regime. If you don't opt, you will be taxed as per the new regime only. Okay. Now, if you want to opt for the old regime, meaning if you want to opt out from the new regime, from the default regime, then if you have an income under PGBP, then you have to opt out on or before the due date referred to in section 139(1) for furnishing return of income. And option once exercised shall apply to the subsequent year. So once you have opted out, you will be governed by the old regime for the subsequent years as well. In any other case, meaning if you don't have an income under PGBP, then you have to exercise the option of opting out for each year on or before the due date of furnishing return of income. So if you're filing a belated return, then you don't have an option. You have to be governed by new regime. Why? Because this option has to be exercised on or before the due date. If you have not furnished the return, you have not exercised the option, then you have to be taxed as per the new regime. Withdrawal of option. If you have income under PGBP, you can withdraw it once, but if you withdraw, then you cannot again opt out from the new regime. So in year 1, you choose old regime. Then in year 2, you can come back to the new regime. But then in year 3, you cannot go back to the old regime. So an option of withdrawal is given only once if you have an income, if the assessee has an income under that PGBP. Okay. If the assessee has income under PGBP, option can be withdrawn once, and thereafter, assessee shall never be eligible to exercise the option except where assessee ceases to have any income from PGBP. So long as you have income under PGBP, you cannot go back to the old regime. In any other case, if you don't have income under PGBP, then it's your choice. Every year you can pick and choose. Assessor can opt in any year. Okay. So this was all about the new regime and the old regime. So if you see under the new regime, the tax rate, the slab rates are concessional. The basic exemption is 4 lakh. While in the old regime, the tax rates are high. The basic exemption is only 2.5 lakh. In the new regime, the 30% tax rate kicks in when the total income exceeds 24 lakh. While in the old regime, the 30% tax rate kicks in when the income exceeds even the 10 lakh. Okay. Even in the old regime, the maximum surcharge rate 25%. So even if income exceeds 5 crore, the surcharge applicable is 25%. While old regime, the maximum surcharge rate is 37%. If an assessee has an income more than 5 crore, he is liable to pay surcharge rate of 37%. Okay. In case of new regime, the rebate is applicable up to an income of rupees 12 lakh. While in the old regime, the rebate is applicable only up to an income of 5 lakh. Okay. Then there's a marginal relief available under the new regime for rebate as well. There is no marginal relief available under the old regime for rebate. Okay. So in all these cases, we saw that the tax rate of the new regime are concessional. Okay. The only one point is that rebate is not available from any special income under the new regime, while old regime allows rebate from all special income except LTCG under section 112A. LTCG on account of transfer of listed securities, equity mutual fund or units of business trust. 112A. Okay, clear? Let's see some question. Mr. X. See, all these things, all this comparison is helpful to you to determine which is more beneficial to the assessee so that the tax liability remains minimized. So the question says Mr. X, aged 34 years and resident in India, has a total income of rupees 11,70,000. So whether the new regime is applicable to resident or to non-resident, only to the resident. So there is no differentiation in case of individual HUF, AOP, BOI, artificial individual person. As if you see in case of company and cooperative society, the concessional, the new regime is available only to the resident, the domestic company or to the resident cooperative society. But in case of individual HUF, etc., the new regime is available even in case of even to assessee who is non-resident. Okay. But the benefit to the old age, senior citizen, super citizen is available only under the old regime. Under the new regime, there's only one slab rate applicable to all individual, whether resident or non-resident, whether less than 60 years, 60 to 80 years, or more than 80 years, irrespective. So there's an X who is a resident in India, has a total income of 11,70,000. Comprising salary and interest on bank fixed deposits. So normal income, no special income. Compute his tax liability under default regime. So very simple, you just have to apply the slab rate. So up to 4 lakh nil, 4 to 8 lakh, 5%. So 5% of 4 lakh is 20,000. Then 8 to 12 lakh, no, 8 to 11 lakh 70,000 means 3 lakh 70,000, 10%. Means 37,000. See? So the total tax is 57,000. But if you see, he is an individual, he is a resident, and his total income is up to rupees 12 lakh, 12 lakh or below 11,70,000. So he is eligible for a rebate of equal to the amount of tax, which is 50,000, 57,000 or 60,000, whichever is less. To enter to a rebate of 57,000, your tax liability is nil. So I told you, in case of new regime, there is no tax liability up to rupees 12 lakh, except in a situation where you have a special income. So this tax liability has become nil because of the rebate. And if you have a special income, rebate is not available from special income, and therefore a tax liability cannot be nil if you have a special income. Next question. Mr. Pallavi, aged 32 years and resident in India, has a total income of 12 lakh 18,000. You understand? In the earlier question, this question is same. She's also individual, resident, but her total income is more than 12 lakh. So she is not eligible for rebate. Good. Comprising his salary and interest income. Compute her tax liability. So very simple. I compute the tax liability on 12 lakh 18,000, but I will not give the benefit of rebate. Why? Because she satisfies two conditions. She is individual, she is resident. But the third condition is not satisfied, which is the total income should be 12 lakh or below. Here the total income is 12 lakh 18,000. So what is the tax liability? Up to rupees 8 lakh, it is 20,000. Then 8 to 12, 14,000. Then on 18,000, 15%. So here comes tax on 18,000 15% plus 60,000 62,700. But in new regime, there is a rebate available qua, there is a marginal relief available qua rebate as well. So there is a marginal relief of 44,700. How I compute marginal relief? I believe that you know this. You just have to compute a tax on 12 lakh and you have to compare the tax, this tax of 12 lakh with the tax on 12 lakh 18,000, which is your income. And the additional tax should not exceed the additional income. The tax on 12 lakh. Tax on 12 lakh you have to compute, and that the tax on 12 lakh is 60,000, right? And tax on 12 lakh 80,000 is 62,000. No, it is 78,000. No, 62,700. And since being rebate under Section 87A would be B minus A 44,700. So the tax shall not exceed the 18,000. So what the rebate say? Tax on additional income cannot exceed the additional income. So the additional income is only 80,000. So the tax cannot exceed 18,000. The tax on 12 lakh is nil because of rebate, and tax on 12 lakh 18,000 is 62,700. So this additional tax, 62,700, cannot exceed the additional income of 18,000. The difference shall be the rebate. So my tax liability shall only be 18,000, which shall be increased by cess of 4%. The total tax liability shall be 18,720. So how we compute rebate? Tax on additional income cannot exceed additional income. Meaning thereby, in this example, my additional income was 18,000, 12 lakh 18,000 minus 12 lakh, and additional tax was 62,700. Means tax on 12 lakh was nil, tax on 12 lakh 18,000 was 62,700. So difference is 62,700. So this 62,700 cannot exceed 18,000. So I restrict my tax liability to 18,000. Clear? And I add cess, and that shall be the total tax liability. Okay. So we'll discuss cooperative societies, the concessional regime to cooperative societies, individual artificial juridical person, the new regime, the old regime. Okay. Now, one relief is provided in section 89A. What is it? So this is in respect of those individuals which were earlier working outside India. So in those years, they were non-resident in India. Okay. So they were doing the job, say in US, UK, Canada, and they were accumulating their retirement benefit there. Okay. Under the laws of such country, such retirement benefit are taxable in the year of withdrawal. So what happened that in all their life, they were there. They were resident of these country and non-resident in India. And therefore, any such income was not taxable in India because they were non-resident in India. But once they leave their job and they got retired, they shift to India and they become resident, right? And once they become a resident, and now after becoming a resident, they withdraw their benefits from their retirement accounts in US, UK, Canada, as the case may be, and such income gets taxed. Okay. So this was the issue. So a relief is provided. It says that when you are resident, then you can opt for this relief. Who can opt? Only a specified person. What he can opt? I tell you who is specified person is a person who was earlier working in these countries and has accumulated some in their retirement benefit accounts. Where specified person has income accrued in these accounts, then he has the option that such income will be included in total income of the previous year, in which the said specific account is taxed at the time of withdrawal. So what happens is that these income in India as per Indian tax law are taxable on accrual basis, while the foreign country taxes on at the time of withdrawal on receipt basis. So the person may opt to get these income tax in India also at the time of withdrawal only. Okay, because what happens is that if you tax these income on accrual basis in India, then there will not be any foreign tax credit. So what would happen? You will tax these income in year one in India, while if the amount is withdrawn in year two, so while in year one you have paid Indian tax, in year two you pay tax in UK. You have paid tax in both on same income twice. So the double taxation, but you are not eligible for FTC because of difference in the year. One country is taxing it in year one, and another country is taxing it in year two. So to give the relief, in this case, there is section 89A was inserted, in which these individuals can opt in India that such income shall be taxable at the time of withdrawal only as being taxed in their home country, US, UK, or Canada, as the case may be. Okay. Not the home country means the country where they were working. So what happened in now what will happen? India will also tax this income in year two only. And there will be then this person can claim foreign tax credit of taxes paid in the foreign country. Because both the countries are taxing this income in the same year. You understand the logic? So what is the option? Where the option has been exercised, the total income of specified person for the previous year in which income is taxable. So in the year of withdrawal, will not income which has already included in the income of a specified person. So if at the time of withdrawal there is some amount which has already been offered to tax in any earlier year, then such amount shall not be taxed in the year of withdrawal. And if there is any amount which accrued to him when he was a non-resident in India, then also, or RNOR, then that amount also is not considered for income tax purpose in India at the time of withdrawal. Okay. But this option once exercised cannot be withdrawn, shall continue to apply. The option has to be exercised on or before the due date. So this option has to be exercised on or before the due date of financial return of income under section 139(1), and it shall be exercised for all specified accounts. The option once exercised for a specified account would apply to all subsequent previous year and cannot be subsequently withdrawn for which option was exercised. Okay. And lastly, what happens is once you exercise this option because you become a resident, but subsequently you became non-resident. So what will happen is that say in year 25-26, the individual opted for section 89A. He was resident. Now in year 28-29, he become non-resident. So what will happen for the year 25-26, 26-27, and 27-28? The Indian government would not have taxed the income on accrual basis because the employee, the assessee, the individual has exercised the option. But now, since you have become non-resident, all these income which we have not taxed because you exercised the option shall be taxed for the year 25-26, 26-27, 28-27. So all these 3 years, the income shall be taxed and the due date to pay tax on these income shall be the date of final return of income for the year 28-29. So understood? Once I opt for this section, any income accrued to my account subsequent to the year of option will not be taxed because I have opted to pay tax at the time of withdrawal. Okay. But before the withdrawal, I became non-resident. Now, if I became non-resident in year 28-29, then in this year, the income cannot be taxed on accrual basis. Why? Because I have become non-resident. But for these 3 years, for the year immediately preceding the year in which I became non-resident, For these 3 years, the income left to be taxed by the Indian government. And now, since you have become non-resident, I will tax these income of these years, but I will give you a time up to the due date of furnishing return of income for the year in which you become non-resident. So clear? So if you read what it says, in case specified person after exercising the option for any previous year, say 25-26, becomes a non-resident during any subsequent previous year, say 28-29, refer to a relevant previous year. So I opted for 89A in PY 25-26. On account of such option, the government will not have taxed my income on accrual basis for the year 25-26, 26-27, and 27-28. Now comes year 28-29 when I become a non-resident again. Then the option exercised above will be deemed to have never exercised. We will be deemed that we have never exercised this option. So by this deeming fiction, what happens? These income for these 3 years, 25-26, 26-27, 27-28, which should have been taxed on accrual basis. Why? Because you were resident in these year in India and income was accruing to your account outside India. So in case of resident, global income is taxable. So these income would have been taxable in India had you not opted for Section 89A. So we deem that you have not exercised this option. So these income left untaxed, which should have been taxed, would be deemed to have never been exercised with effect from relevant previous year, 28-29. The income which has accrued in the specified account during the previous year, beginning with the previous year in which option was exercised, 25-26, till the previous year, immediately preceding the relevant previous year. You understand why I'm telling you preceding the relevant previous year? Because during the relevant previous year, you became non-resident. So relevant previous year, 28-29, you have become non-resident. Such income is even otherwise not taxable in India because you are non-resident and such income is accruing outside India. Okay. So by exercising this option, what the Indian government has left out? This left out the tax on income from the year in which you exercise this option up to the year preceding the year in which you become non-resident. So only those years where you were resident, government have left to tax this income. Okay. So such income would be taxable during the previous year, immediately preceding the relevant previous year. The tax on such income was to be paid on or before due date of furnishing return of income for relevant previous year. So I have given you time to pay that tax. The tax pertain to previous year 25-26 to 27-28. But I give you time to pay tax on these income up to the due date of furnishing return of income for PY 28-29. Because only in PY 28-29, I came to know that these income should have been taxed. There is a change in the residential status in 2029. Because of such change, this income became taxable. Okay. FTC paid on such income would be ignored for the purpose of computation of foreign tax credit. Okay. The meaning of certain terms: an account maintained. What is a special account? It's a retirement benefit account. How is it written? An account maintained in a notified country by specified person in respect of his retirement benefit, like similar to what PF account is there. And income from such account is not taxable on accrual basis, but is taxed by such country, the country in which this account is maintained, at the time of withdrawal or redemption. So if there is an account on account of retirement benefit and the country, such country tax such benefit only in the year of withdrawal and not in the year of accrual. Only we are talking about such accounts. Because the issue arises only in respect of such account only. What is the issue? The income, India taxes such income on accrual basis. The foreign government taxes such income at the time of withdrawal. So there is a difference in year and the individual has to pay tax to both the government on the same income, resulting in double taxation. The benefit of foreign tax credit is not available because the income is taxed in both the countries in different years. So the benefit is not available. When India taxes income, there is no foreign tax paid, so no FTC. Okay? Notified country. Means the country notified by the central government. So far, Canada, US, and UK have been notified. Specified person. A person resident in India who opened a specified account in notified country while being non-resident in India and resident in that country. Who is a person who is eligible for this benefit? He is a person who is now resident. But when he opened his account, this special account, this retirement benefit account, he was non-resident in that country, in India, and he was resident of that country. Clear? So we discuss about cooperative societies. We discuss about individuals. We discuss the tax rate which is applicable to individual, HUF, AOP, BOI, artificially educated person. Then we discuss about the rebate, the benefit in section 89A, which is available only to the individual, to the resident individual. Okay, you understood? Now let's discuss about the HUF. So what is an HUF? So under income tax, it's a separate entity. So it's a separate PAN number. You can do business, you can earn income in the name of HUF. And such income shall be taxed in the hands of HUF and not in the hands of the members of the HUF. Okay. So Income Tax Act does not define HUF, but in the Hindu law, HUF means a family which consists of all male members lineally descended from a common ancestor and include their wives and daughters. Okay. The members of HUF who are have a same blood are called co-partner. They are related to each other and to the head of the family. HUF may have many members, but only 4 degrees, including the head, the karta, is considered as co-partner. Who is co-partner? Co-partner have a important right that they can ask for the partition. With effect from September 6, September 2005, even the daughter has been given a status of co-partner. The daughter is a co-partner in her father HUF and not in her husband's HUF. Okay. Only co-partner have a right to demand partition. So, under Income Tax Act, Jan and 6 are also eligible to form HUF. Okay. So, in case of HUF, there are 2 things: co-partner and the members. Co-partner are the person who has the same blood relationship with the karta and the 4th generation of the, including the karta. Okay. They can ask for the partition of the HUF. Okay. The daughter is a co-partner of her father's HUF. Okay. Now, there are 2 schools of law in the Hindu law: Mitakshara school and Deyabaga school. Mitakshara school is prevalent only in case of in all India except West Bengal and Assam. Deyabaga school is only in case of West Bengal and Assam. The Deyabaga school says that the member shall not acquire right or share in the property by birth as long as the head of the family is living. So son does not get a right in the property of the family unless his father or the head of the family is living. So he gets the right only on the death of his father. Okay. This Deyabaga school is applicable, this law is applicable only in West Bengal and Assam. For all other part of the country, the Mitakshara school of law is applicable, where the member, the co-partner of the HUF gets a right by birth. So one acquires a right to the family property by his birth and not by succession, irrespective of the fact that his elders are living. Okay. So in West Bengal and Assam, the one gets a right only after the death of the elders, while in Mitakshara school of law, one gets the right by birth, even if the elders are living. So in Deyabaga, the children do not acquire any right or share in the family property as long as his father is alive, and only on the death of father, the children will acquire right or share in the property. And the father and brother would be the co-partner of the HUF and not their sons. While in Mitakshara, every child born in the family acquire right or share in the family property. Okay. So tax rate applicable to HUF, you understand? You understand what is HUF? What are the two school of law? One is applicable in West Bengal and some, and other is applicable in rest of the India. Okay. Now, assessment of HUF after partition. Firstly, the Income Tax Act does not recognize partial partition. So if there is a partial partition, the Income Tax Act deems that there is no partition. What do you mean by partial partition? Either the partition is made only in respect of some of the co-partner of the HUF or members of the HUF, or partition is made only in respect of some of the property of the HUF. So there's no full partition means either the all the property is not partition distributed, or the partition limited to some of the members, not to the all the members. In either of these cases, there's a partial partition. So full partition, the all complete entire property of the HUF has to be distributed among all the members of the HUF. If either of these is partly, either the property is part or the members are not the complete whole, then it's a partial partition which is not recognized by Income Tax Act. And for income tax, there is no partition if there is a partial partition. Okay. In case of partial partition, all the income is taxed in the hands of HUF only. Okay. So HUF is as an HUF unless there is a total partition of HUF. If at the time of making an assessment, some of the member raises a point that a partition has happened, then tax officer shall make an inquiry, and on completion of inquiry, he shall record a finding whether there is a full partition or not. If there is a full partition, then the income of the HUF up to the full partition shall be taxable in the hands of HUF, and whoever are the members shall be jointly and severally liable for the dues of the HUF. If the partition happens after the assessment, then whoever was the member on the date of such partition shall be liable for the dues of the HUF. Okay. So similar to the partnership form. It says, where finding of partition has been recorded by AO, the total income of HUF up to a date of partition shall be assessed in the hands of HUF, and each member shall be jointly and severally liable for sum payable on the income so assessed. Okay. If AO finds after completion of assessment of HUF that a partition has already been effected, every person who was member before the partition shall be jointly and severally liable for any sum payable on the income of the HUF so assessed. However, the several liability of any member shall be computed according to the portion of HUF property allotted to him. Okay. So what do you mean by partition? Partition means physical partition of property, but a physical division of income without a physical division of property producing the income shall not be deemed to a partition. So if the source of income has not been partitioned, but only the income arising from such source has been partitioned among the members of the HUF, then income tax does not recognize such partition. Okay. So, firstly, we understand what is HUF. Daughters are also a member of their father HUF, to school of HUF, then partition of HUF. Firstly, the partition should be in respect of property and should not be in respect of income originating from such property. Secondly, Income Tax Act does not recognize partial partition. Thirdly, if at the time of assessment there is an allegation that the HUF has partition, then AO will do the inquiry and record a finding whether partition has happened or not. If he has recorded a finding that there is a partition, then income up to a date of partition shall be assessed in the hands of HUF, and all the members shall be jointly and severally liable for the dues of the HUF. If AO has got a finding after the assessment there is a partition, then whoever the members were there before the partition shall be jointly and severally liable for the liability of the HUF. Okay. And the several liability shall be as per the portion of the asset allotted to him from the HUF property. Okay. So we understand about the basic of the HUF. We'll break for a 5 minute or 7 minutes break and will again assemble on 7:32. Okay, and continue. So till now we discussed about cooperative society, individual. Now we are discussing about the HUF, and which we will continue after a 5 minutes break till 7:32. Thank you. HUF. Okay. We discussed the meaning of the HUF and about the partition of the HUF. Okay. Now, one important point. Something special provision related to computation of income of HUF. One, you all know scrubbing. If any individual member transfer his individual property into the pool of the HUF property, the income from such property shall be clubbed with the in the hands of individual member. So income from transfer of self-acquired property by an individual to his transfer to his wife, to his HUF, for inadequate consideration is not considered income of the HUF. So if an individual member has transferred his self-acquired property to the HUF for an inadequate consideration, or has converted his self-acquired property into the property of the HUF, then income from such property shall not be considered as income of the HUF. Such income from such property shall not be taxed in the hands of the HUF. Such income shall be clubbed with the hand of the transferor individual. Okay. It will be included in the income of the individual member who transferred the property to the HUF. Okay. Then the share of profit from the HUF to the member is exempt in the hands of the member, similar to partnership. Section 10(2) says, exempt any received by an individual as member of HUF out of the family income. Okay. Now this is important. What it says that if a member of HUF receive any fee remuneration as a director or partner in a company or firm as a consequence of the investment made in such concern out of funds of HUF, such fee or remuneration shall constitute income of HUF. So I explain you what happened is that this HUF has from its own fund made investments, say in A Limited. Now a member of HUF, say Karta of HUF, is a director in this A Limited and he is getting the salary. Now the law says this salary, though received by Karta, shall be taxable in the hands of HUF. Okay. Why? Because the investment in A Limited is made from the funds of the HUF. So it is determined to the funds of the HUF, and therefore the remuneration which has been paid to the Karta shall be taxable in the hands of the HUF. Okay. The exception is it's not taxable in the hands of HUF, it shall be taxable in the hand of Karta only if it is proved that it is on account of professional skill, knowledge, or experience of the Karta. Okay. But if it is proved that this amount is paid, the A Limited is paying this amount to the Karta in consideration for the funds invested by HUF in A Limited, then such amount shall be taxable in the hands of HUF only. So understood? We are not talking about the interest. We are talking about the fees or remuneration received by any member of Karta from any concern in which the HUF funds have been invested. Then such fee or remuneration shall be taxable in the hands of HUF and not in the hands of the member. This happens because it is assumed that this amount is paid as the HUF has invested its fund in the concern. Okay? So HUF has invested a fund. For the consideration of it, it has paid remuneration to Karta or the member as the case may be, and therefore such remuneration should be taxable in the hands of HUF only. But if it is proved that such remuneration is paid not on account of this investment, but purely on account of professional skill, knowledge, and experience of the Karta, then such remuneration shall not be taxable in the hands of HUF. It shall be taxable in the hands of Karta or member as the case may be. See? if member of HUF receive any fee or remuneration as director or partner in a company or a firm, as a consequence of investment made in such concern, in such company or a firm, out of the funds of the HUF, such fee or remuneration shall constitute income of the HUF. Okay. But the Delhi High Court said that if investment plays a minor role and is primarily the personal effort, specialized skill, and enterprise of the individual co-partner, which resulted in the new business being set up and profit accruing, it may essentially be said that income belongs to the, it may not essentially be said that income belongs to the HUF. In such case, income belongs to this co-partner because it's on account of their professional personal skill. When the remuneration received, however, when the remuneration is received by the co-partner, though not in form, but in substance was one of the mode of return made to the family because the investment of the family funds, it has to be assessed as the income of the HUF. Understood? So, though the concern is paying remuneration to the member, but in substance, it is a return on account of the funds invested by the family to the concern. Then such remuneration shall be taxable in the hands of the HUF. So we will go by the substance, not by the form. If the remuneration is not paid to the detriment of the family funds, it is assessable as the income of recipient karta or co-partner as an individual. Any such fee or remuneration earned by a member as a director or partner for service rendered purely in his personal capacity will be included in the income of individual member only and not to the HUF. You understood? If a HUF has invested in a concern is incorporated with the funds of the HUF. Say the members of the HUF have formed a concern with the help of the funds received from the HUF. Then the remuneration so received by the members shall be taxable in the hands of HUF because it is deemed that it is in substance a return made by the concern on account of investment by the HUF in such concern. However, if it is proved that it is on account of personal skill, knowledge, experience of the member, and the investment plays a very minor role, then such amount shall be taxable in the hands of such member only. Okay. Now, some basic point, though not much relevant from taxation point of view, but a part of your course. So it says, if a karta is a partner in his individual capacity in a partnership firm with some strangers, then it doesn't mean that other members of the HUF are also partners. Okay. But the creditor of the firm are entitled to proceed against the HUF asset, including the share of non-partner co-partner for their debts. So only the karta is a partner in his individual capacity, but the creditor of the firm can go against the assets of the HUF, even to those assets which pertain to the share of other co-partner. Okay. This is because under HUF, the karta has right when carrying on business to pledge the credit of the joint family to the extent of its assets. So, in HUF, karta can pledge all the assets of the family, even the assets which are not outside of his own share. The liability on the part of other member of the HUF arises by reason of their status as co-partner and not by reason of contract of partnership. Understood? If the HUF pays salary to the karta member, then if the salary is genuine, bona fide for the services performed by such karta member as the case may be, then such salary shall be allowed a reduction in the hands of HUF. If remuneration is paid to the karta member of HUF under valid agreement which is a bona fide and in the interest of an expedient for the business of the HUF, and payment is genuine and not excessive, such remuneration would be an expenditure laid out wholly and exclusively for the purpose of business of family and would be allowable as a expenditure. Okay. So this was all about the HUF. Now we practice one or two questions. and then we'll move to our next entity, AOP or BOI. Mr. Ram, age 56, is the Karta of his HUF. So there's a Ram who is the Karta of HUF. The HUF consists of himself, his wife, and two sons, with Mr. C, age 28 years, and minor D, age 16 years. So who is the Ram, who is the Karta of HUF? The HUF has four members, the Karta, his wife, and a major son C and a minor son D. The HUF is assessed to income tax and as business income from the year 2015-16. So HUF is carrying on business and assessed to income tax since long. The business income of HUF for the year ended 31st March 26 is 5 lakh. So during the relevant previous year, the HUF earned a business income of 5 lakh under that PGBP. Mr. Ram, the Karta, is employed in a private company and his salary income for the same period is 6,10,000 computed. So Mr. Ram is also an employee and is driving a salary of 6,10,000. You are requested to answer the following, treating each of them as independent situation. Okay. Mr. C gave cash gift. Mr. C means the major son. Gave cash gift of rupees 1 lakh to the HUF of Mr. Ram. What would be the total income of HUF? So, Mr. C has given a gift of rupees 1 lakh to the HUF. The question is whether such gift is taxable in the hands of HUF or not. Pause for a second and think. Gifts are taxable under that other sources under section 56 to 10, but gifts from relative are not taxable. And for the HUF, members are treated as a relative of the HUF. And since C is a member of the HUF, so any gift received by HUF from its member is not taxable under the head other sources. So this 1 lakh so received by HUF is not taxable in the hands of HUF. The cash gift of 1 lakh by major son to HUF will not be taxable in the hands of HUF since gift from relative of HUF does not fall in the scope of income under section 56 to 10. And total income of HUF will continue to be 5 lakh under that PGBP only. Clear? Now the second part is, it says the HUF has one house property fetching rent of 10,000 per month and some movable asset. Okay. There is a proposal to make a partial partition of HUF by allotting the house property to Mr. C. Is it advisable to do a partial partition? So it says that there is a house property in the HUF from which it is driving a rent of 10,000 per month. Who? The HUF. Now, the HUF is contemplated to do a partial partition. It's not doing a complete partition of all the assets, but only doing a partial partition by which it will transfer this building, this house property to a major sum C. Okay. But I told you that under the Income Tax Act, partial partitions are not recognized. And therefore, even if there is a partial partition, the income of 10,000, the rental income, shall continue to be taxed in the hands of HUF only. So it's not advisable to go for partial partition. Partial partition is not recognized, and HUF, which has been hitherto assessed to tax, shall continue to be liable to be assessed as if no such partial partition has taken place. Okay. So the rental income in this case will continue to be assessed in the hands of HUF even after partial partition. Therefore, it is not advisable to go for partial partition. Clear? Minor D earned rupees 70,000 by use of his special skill and talent. How will his income be taxed? So the minor son D has earned some income. So income of minor is clubbed with the income of the parent, whosoever income is higher. But there is some exception. If the income of minor is on account of his specialized skill and talent, then such income is not clubbed with the income of parent. Such income is taxed in the hands of minor only. So this income of rupees 70,000 is by use of his special skill and talent, which shall not be clubbed and shall continue to be taxed in the hands of D only. income of 7,000 earned by D by use of his special skill and talent would be taxable in his individual hands, no clubbing. It will not be included in the hands of his parent by virtue of exception to section 64(1)(a) contained in proviso to section 64(1)(a). That is, if income of minor is on account of his special skill or talent, such income shall not be clubbed. There is one more exception, which is if the minor is suffering from any disability referred to section 80U, then also income of minor is not clubbed with the income of parent. A car owned personally by Mr. Ram was blended with HUF. Means the personal asset of a member of the HUF is transferred to the HUF during the year for an inadequate consideration, blended with HUF. It was leased out for a monthly rent of 10,000 from 1st October 2025. How would this income be taxed? So clubbing provision will apply. This lease income of 10,000 shall not be taxable in the hands of HUF and shall continue to be taxed in the hands of transfer member, which is Mr. Ram. As per section 64(2), where a member of HUF blends his self-acquired property for inadequate consideration with the HUF, income derived therefrom is deemed to be the transfer member and not to the HUF. In this case, Mr. Ram has blended his personal property with the HUF. Since there is no consideration, the income from car would be deemed as income of Mr. Ram. Okay? You have to compute the income. For computing the income, you will allow the expenses in earning such income. One of such expense shall be depreciation. Clear? So we discuss about individuals, we discuss about the HUF. Now the last topic we are discussing about AOP or BOI. What is AOP or BOI? AOP means association of person, BOI means body of individual. So if individuals are members, then called BOI. If a person other than individual also a member, then we call it as association of person. Okay. So AOP or BOI are separate entities. They are taxable under the Income Tax Act in respect of income accrued to them. Okay. Section 167B deals with the tax rate applicable to the income of AOP BOI. Firstly, it says if the shares of the member are indeterminate at any point of time. If the shares of the member are not definite or indeterminate, then the AOP BOI shall be taxable at a minimum rate of MMR, maximum marginal. Okay. Minimum means, in this case, if any of the member of the AOP or BOI is taxable at a rate more than the MMR, then the entire income of AOP or BOI shall be taxable at such rate. However, if no member of AOP or BOI is taxable at a rate more than the MMR, the total income of AOP or BOI is taxable at MMR. So what I told you, it says if the share are indeterminate, then we'll see whether any member of AOP is taxable at a rate more than MMR. If yes, then the total income of AOP or BOI shall be taxable at such rate, the rate at which such member is taxable. But if there is no such member, then the total income of AOP or BOI shall be taxable at. So, what's the conclusion? If the share of the member is indeterminate, then the AOP is taxable at least at MMR. It may tax at rate more than MMR if it has any member who in his individual capacity taxable at a rate more than MMR. Okay? But if the shares are determinate, means specific share of rate is given. Okay. Then, if there is any member in the AOP who is taxable at more than MMR, then only his share, income up to his share taxable at such rate, and other income is taxable at MMR. if there's a member who has income more than the basic assumption limit, then whole of the income of the AOP shall be taxable at MMR. And if there's a member, if no member of the AOP is assessable, it has an income more than the basic assumption limit. All the member has income other than the income from AOP less than the basic assumption limit. Then the AOP is taxable at regular. You understand? In most of the cases, the AOP is being taxed at least at MNR. So what it says, where share of the member are indeterminate or unknown. If it has, in this case, what I told you, the AOP shall, the entire income of the AOP shall be taxed at least at MMR. So first you have to see whether the AOP has any member whose income is taxable at more than MMR. If yes, then the entire income of AOP shall be taxable at such rate. But if AOP does not have any such member, then the entire income of AOP shall be taxable at MMR. So if the share of member is indeterminate, the AOP is taxable at least at MMR. What if its shares are determinate? Then if there is any member who is taxable at more than MMR, then income only up to such share of member, only up to a share of such member, share in total income. Such member share in total income, only income up to such share shall be taxable at such rate, or remaining income shall be taxable at MMR. If there is no such member who is taxable at more than MMR, then you will see, is there any member whose income other than income from this AOP is more than basic exemption limit? Then the entire income of AOP is taxable at MMR. There is only one case where the AOP is taxable at regular rate. Regular rate means the slab rate which we discussed under new regime, under the old regime. 4 lakh, 2.5 lakh is the case maybe. The case is if none of the member is taxable at a rate higher than the MMR and none of the member has income other than this income, other than income from AOP, more than the basic assumption limit. Only in this case, the income of AOP is taxable at regular rate. Otherwise, the income of AOP is taxable at least at MMR. You understand? So if the shares is indeterminate, then if there's any foreign company, why we call foreign company? Because foreign company generally taxable at a rate higher than the member. Then if any foreign company is a member, then the entire income of AOP is taxable at the rate applicable to foreign company. In any other case, means foreign company is not a member or no member is a foreign company, then the entire income is taxable at MMR. Even if shares determinate. If there is a foreign company, the income up to a share of such foreign company shall be taxable at such rate which is applicable to foreign company, or the remaining income taxable at MMR. If there is no foreign company, but even if a single member has other income more than the basic assumption limit of 4 lakh or 2.5 lakh, the case may be, then the entire income of AOP shall be taxable at MMR. The entire income of AOP shall be taxable at regular rate only if no member of AOP has other income more than the basic assumption limit. Clear? So the tax rate are quite high in case of AOP. Okay, before that, before attempting a question, let's discuss section 86. Repeat. If you remember, we discussed section 86, we talked about section 86. We took a reference of section 86 in the last class while we were discussing MAT. So it says that if the income is not taxable under section 86, such income is not liable to MAT also. Okay. So what section 86 says? Section 86 says if the AOP is taxable at least at MMR, then the share of income of member from such AOP shall be exempt. Now, since AOP has already been taxed at the highest rate, the share of member from such income shall not be again taxed in the hands of member. So, if income of AOP is chargeable tax at MMR or higher rate, then tax treatment of share of member in the income of AOP shall be exempt. So, whatever income which the member is deriving from the AOP shall be exempt in the hands of the member because the AOP has already paid tax at the MMR or the higher rate. But if the AOP is chargeable tax at slab rate, this happens only when the shares are determinate, no member is taxable at a rate higher than MMR, no member has income other than income from AOP more than the basic exemption limit. If all these three things have satisfied, these three conditions satisfy, only in such case the income of AOP is taxable at slab. In such case, the member shall be allowed a rebate under section 86. And the rebate shall be average rate of tax allowed in respect of his share in income of AOP. If no tax is payable by AOP, the member share shall be taxable and no rebate is available. Okay. So if the AOP has paid tax at MMR or higher rate, then a member share is fully exempt in the hands of the member. If AOP is taxed at a regular rate, slab rate, then member is entitled to a rebate equal to the average rate of tax on such share. If AOP has not paid tax at all, then the share of member is taxable in his hands and no rebate at all. Very simple. Okay. Whenever two persons join together and do a business, we tax such business under the head AOP. The only exception is section 26 under the head house property. What it says if a house property is jointly owned, managed, or controlled, still income from such property shall not be taxed as AOP, shall be taxed individually in the hands of each such owner. Section 26 specifically provides an exception to the assessment of co-owners as an AOP. According to that section, where the share of co-owner in respect of income are definite, the co-owners must be assessed not as AOP, but individually, even if the property may be owned, managed, and developed jointly by the co-owners. Okay. A partnership which is illegal or otherwise void is taxed as AOP. Okay. So, what we discussed? We discussed tax rate applicable to AOP 167B section, which says if the share of member indeterminate, then the AOP is taxable at MMR or the higher rate, as the case may be, higher rate when it has any member which is taxable at a higher rate. If shares are determinate, if it has any member which is taxable at a higher rate, then the income of AOP to the extent of share of such member shall be taxable at such rate, which is applicable to such member, and the remaining income is taxable at MMR. If shares are determinate and AOP has no such member which is taxable at higher rate, but if it has any member whose other income is more than the basic exemption limit, then the entire income of AOP is taxable at MMR. If the shares are determinate, it has no member which is taxable at higher rate, and no member has other income more than the basic exemption limit, then only the AOP is taxable at a slab rate. JK Associates is Mr. J and K to the relevant previous year. Is 5 BKC. Is 5 BKC. Okay. The AOP is flag and the K is 2. So the shares are determinate. AOP does not have any member who is otherwise taxable at a rate higher than the MMR. Here, the other income of J is 2.5 lakh and is opted for the old regime. Under the old regime, the basic exemption 2.5 lakh. So its income is up to basic exemption limit. The K has another income of 2.9 lakh. It is, if it had opted for the old regime, then its income would have exceeded the basic exemption limit. But the question said that K pays tax under default regime, the new regime, and the basic exemption limit in the new regime is 4 lakh. So his income is also less than the basic exemption limit. So all the three conditions satisfied. The AOP has no member which is taxable at more than MMR. The shares are determinate, and no member has an income, other income, more than the basic exemption limit. So the income of of AOP shall be taxable at slab rate. So this 11 lakh shall be taxable at slab rate. And the AOP has opted for the default tax regime. So slab rate is no tax up to 4 lakh, 4 to 8, 5%, and 8 to 11, 10% plus cess. Okay. Whether AOP shall be eligible for the rebate? Tell me. Since its income is less than 12 lakh, it's only 11 lakh, will we provide the rebate to AOP? Of course, the answer is no, because rebate is available only to resident individual. Okay. So, tax liability of AOP. 4 to 8 lakh, 5%. 8 to 11 lakh, 10%. 50,000, set 52,000. Now talking about the tax liability of the members. So they have their income 2.5 lakh and 2.9 lakh. This is income other than the income from AOP. They will also receive the share in the income from AOP. And what is the share? So Mr. J and K. So J has other income 2,50,000 and K has other income 2,90,000, right? Now share in income of AOP, which is 60% for J. So 60% of 11 lakh, 6 lakh 60,000, and 40% for K, 4 lakh 40,000. Okay. So this income 9 lakh 10,000 for J and 7 lakh 30,000 for K shall be taxable in the hand of J and K. Why taxable? Because AOP has not paid tax at MMR or higher rate. So this income, this share shall not be exempt. Had AOP been paid tax at MMR or higher rate, then this share would have exempt in the hands of member. But now, since AOP has paid tax at slab rate, though not MMR, this share is taxable, but the member shall be eligible for a rebate under section 86. And how we compute the rebate? First I compute a tax on 9,10,000. The J has opted for the old tax regime. So for old tax regime, 9,10,000 minus 5 lakh into 20% plus 12,500. It comes 94,500 plus 4% cess, 3,780. So it comes to 98280 is the tax. But I will be eligible for a rebate. For rebate, I need to compute average rate of tax. How I compute average rate of tax? Tax divided by total income. So 98280 divided by 9,10,000. It comes to 10.80%. This is my average rate of tax. I'll apply this average rate of tax on share income from AOP, which is 6,60,000. So 71,280. How I compute 71,280? 10.8% of 6,60,000 being shared in the AOP. Right? So I'll be allowed a rebate of 71,280. The difference I will be able to pay. So see, 6,60,000 is the share in the AOP, 250 other income, total income 9,10,000. I compute tax under the old regime, 98,280, including cess. I compute the average rate tax divided by income, comes to 10.8%. I'll apply this rate to the share of income from AOP, which comes to 71,280. And this is the amount of rebate which Mr. J shall be eligible. The net tax liability shall be 27. Clear? Similarly, for K, if you see, the share is 4,40,000, other income is 2,90,000, the total income is 7,30,000, and I'll compute tax on this 730 under the new regime. For the new regime, up to 4 nil, from 4 to 7,30, 5%, it comes to 16,500. Plus cess, the tax comes 17,160. I'll compute the average rate by dividing a tax from the total income. It comes to 2.351%. So the difference, the J is taxable at 10.8% and K is taxable at 2%. Why? This is the difference in the tax rate and the new and the old regime. So I'll apply this 2.31% on the 4,40,000 share of profit from the AOP. This is 10,344. So the difference is the tax. So I'll be eligible for rebate of 10,344, and the difference is the tax payable by me. So clear? Now you can compute, you understand how to compute rebate under section 86. Firstly, you must know when the rebate is available. It's available only in one case, when the AOP has paid tax at slab rate. If AOP has paid tax at MMR, then no question on rebate because the entire income from AOP is not taxable. And if AOP has not taxed at all, has not paid tax at all, then also no question of rebate. The entire share of member is taxable in his own. Okay. Next question. T and Q are individual aged 28 years and 30 years respectively, who constitute an AOP. So T and Q are two members. They have formed an AOP, sharing profit and ratio in the ratio of 2:1. So share are determinate. For the accounting year ending 31st March 2026, the profit and loss account of the business is as under. So the question gives a P&L account of AOP. The sales of 49,900,000, then there's a dividend 25,000, and long-term capital gain computed 6,40,000. Cost of goods sold 42,50,000. Then remuneration paid to T 130, Q 170, and other employees 256. Then it has also paid interest to members. The AOP has paid interest to T and Q. There's other expenses. Then GST penalty due 39,000, and we have computed net profit. Additional information is furnished. The other expenses 1,11,700 include wristwatch costing 2,500 each were given to 12 dealers who had exceeded the sales quota prescribed under the sales promotion scheme. So if the AOP has given wristwatch to its dealer, that's a business expenditure, nothing to be done. It's an allowable expenditure, already debit to P&L account, no adjustment. Employer contribution of 6,000 to PF for the month of November was paid on 14 Jan 2026. So employer contribution to PF is a part of section 43B. It is allowed if it's paid up to the due date of return of income. It's paid within the financial year itself, so allowed, no adjustment. Rupees 30,000 was paid in cash to an advertising agency for publicity. It is to be added back under section 48(3) because paid in cash in excess of rupees 10,000, the prescribed limit. Outstanding GST liability penalty was paid on 15 October 2026. Okay. The penalty was imposed for non-filing of return and statement by due date. So it's not a compensatory penalty, it shall be disallowed under section 37. T and Q had for this year income from other sources of 4,60,000 to 32 respectively. Okay. You are required to compute total income of AOP. Do. So very easy. We'll do the computation and compute the total income of AOP. We'll start with the net profit. So net profit 5,24,300. Then we'll make the adjustment. Any amount paid to the members shall not be allowed towards remuneration or interest under section 40BA. So first I'll add whatever is paid to the members. So I have paid interest 48,300 and 35,700. So aggregate interest shall be disallowed. 30,000 of advertisement expenditure disallowed because paid in cash more than 10,000. Remuneration paid to partner again disallowed under section 40BA 3 lakh. GST penalty being not in compensatory nature shall be disallowed. So this is the addition. Now the income credit to P&L account but not taxable under PGP. PGBP shall be reduced. This dividend and long-term capital gains. So this amount 3,12,300 is the PGBP. Okay. The long-term capital gain is 6,40,000 given with taxable under capital gain and 25,000 dividend taxable under other sources. This is the total income of AOP. Now this is the question. The share is determinate and the other income of the individual this and this. Tell me the rate applicable to the AOP. I tell you, shares are determinate, but one of the members has other income more than the basic assumption limit. So the entire income of AOP is taxable at MMR. So this 9,77,000 taxable at MMR. And once the income of AOP is taxable at MMR, the share of profit in the hands of members shall be exempt. Members may have to pay tax on their total income, taking into account savings and investment, etc. Since one of the members' total income, excluding the share of AOP more than the basic exemption limit, Mr. T, more than 4 lakh, the AOP will be charged at MMR. Since AOP is taxed at MMR, the share of income is not taxable in their hand individually, as per section 86. Clear? So this completes my AOP. Now, local authority. So what are local authority? These MCTs and all are local authority. So firstly, they have given an assumption of section 1020, clause 20 of section 10, which says that income of local authority, except under PGBP, is not taxable. So income of local authority under capital gain, other source, or house property is not taxable, is exempt. And even income from business, if it is for supply of commodity or service or water or electricity, it is not taxable. So this is the assumption allowed to local authority. Now, mutual concern. Remember, in the starting of the class, we did the first question where the benefit of mutuality was given, where I told you that the code had said that no one can earn income from his own self. Okay? This is the concept of mutuality. So, in case of mutual concern, for concern other than trade, professional, and similar association, any income derived from its member is exempt on the account of mutuality, and any income derived from non-member is taxable as usual. Okay? So, the concept of mutuality applies only, qua members. So, trade, professional, similar association. So this was a rule for concerns other than trade, professional, similar association. For trade, professional, similar association, section 28 PGBP says that any income from specified service shall be taxable under PGBP. But general service to the members, surplus shall be exempt, but if there's deficiency, such deficiencies can be set off against PGBP or income under any other head, but deficiency cannot exceed 50% of total income of the concern. Okay. If it exceeds 50%, the excess shall be ignored, and only up to 50% shall be set off from PGBP or income under any other. But before setting off deficiency, you will set off any losses or depreciation eligible under any other provision of the Act. While adjusting deficiency, effect shall first be given to any other provision of this Act under which any allowance or loss in respect of any earlier assessment year is carried forward and set off against income for the revenue assessment. So it means before allowing deficiency, you will give effect to any other provision of the Act, and even after that, any income remains, then you can set off such income from the deficiency. But deficiency only up to 50% of the income can be utilized. This benefit deficiency is available only to those organizations who do not distribute surplus to its member. Okay. If the association distributing surplus to its member, then benefit of the deficiency is not available. With a small chart for your reference, which will help you, which will summarize what we discussed in the about mutual consent. So we'll divide mutual consent in two parts. One, trade professional similar association, another other association. So for other association, the law is very simple. Any dealing with the member is not taxable. Any loss, not that loss. Any dealing with the non-member, taxable. For non-members, taxable. Any loss allowed. Okay. For trade or professional association, dealing with the members, specified service, if there's an income, taxable, there's a loss, set off allowed. Taxable under PGBP, loss, if any, shall be allowed to be set off. It's a normal loss under PGBP. For other services, so this was about specific services to the members. Other general service to the member, surplus, not taxable. But there's a deficiency. Then section 44A applies if the association is not distributing surplus to its member, meaning what section 44A says, the deficiency can be set off against PGBP or any other income, but deficiency amount cannot exceed 50%. And before giving effect to deficiency, the brought forward loss or deficiency shall first be adjusted. Only after that, deficiency shall be adjusted. Okay. But if the association is not distributing surplus, then 44 is not applicable, and in such case, deficiency has no tax duty. Okay. Income from non-member, irrespective of the nature of the mutual concern, it is taxable, and if there is a loss, such loss is allowed. Now we came to the last topic of our class and this chapter, tonnage taxation. So, if I tell you, what is tonnage taxation? To make you revise. First, tell me how income is taxed. Whatever you earn in money terms is your income, and you apply the tax rate. This is a tax liability. But in case of shipping, there is an inherent problem in this sector. The freight keeps on changing. Okay. So they are capital intensive, very heavy capital intensive. So to promote this sector, the government brought this scheme, tonnage taxation. In this, whatever the shipping companies earning from the freight by carriage of passenger or goods or material, as the case may be, is not tax. The income is dependent upon the capacity of the ship. What the ship is earning is not relevant. What is the capacity of the ship? The income is computed based on the capacity of the ship. This is a presumptive section, presumptive head, presumptive chapter, chapter 12G. And such income is taxed. Okay. So this is a very beneficial scheme provided to the Indian shipping companies. Not only shipping company, but also to the Indian inland vessel. So earlier it was available. This scheme is available only to the shipping companies, but now it has been extended to the inland vessel as well. So if the company opts for this section, then the income in respect of such ship is not computed under PGBP. This chapter overrides the entire PGBP head. Okay. This section is applicable only to a qualifying company. So for applicability of this section, first the company has to be qualified company and it should have a qualifying ship. So what do you mean by qualifying company? It means an Indian company whose poem is in India. Poem means where the board of directors are taking decisions. But if decisions are not taken by board of directors but taken by some executive members, means the place where such executive members are actually taking the decision. So if the company is an Indian company, it has a poem in India, it owns at least one sorry, it owns at least one qualifying ship, and the main object of the company is to carry on business of operating ship. That is, if a company fulfills all these four conditions, it should be an Indian company and should hold at least one qualifying ship. Then it's eligible for this scheme. This scheme is not mandated at the option. But once you exercise, then you have to stay in this scheme for a reasonable good period of time. Now, what is a qualifying ship? Qualifying ship means a seagoing ship which has a net tonnage of at least 15 tons. So a seagoing ship or vessel of 15 net tonnage or less. Okay. The ship should be registered under the Merchant Shipping Act or Inland Vessel Act. Or if a ship is registered outside India, then it must have a license from the DG Merchant Shipping, DG of Shipping, Director General of Shipping. And very important, it must have a valid certificate which states the net tonnage, which indicates the net tonnage. Why? Because basis of net tonnage, I will have to compute my income. Okay. I am not concerned about the actual freight received by the shipping company. I am only concerned about the net tonnage of the ship. This will only give my presumptive income. A qualifying ship does not include a seagoing ship whose main purpose is for which it is used is provision of goods or service. This is generally available online. A fishing vessel is not considered as a qualifying ship. A factory ship or pleasure craft, the cruise are not considered as a qualifying ship. A qualifying ship which is used as a fishing vessel for more than 30 days in a year disqualify as a qualifying ship. Okay. So a ship which was otherwise qualifying, but if it is used as a fishing vessel for more than 30 days, then will not be treated as a qualifying ship. Tonnage. How you compute tonnage income? So we have to compute daily tonnage income. And such daily tonnage income is multiplied by the number of days the qualifying ship operated. Okay. See, this is a big chapter, but not much relevant from exam point of view, but we will cover everything. Okay. So what is the daily tonnage income? It is a slab. It depends upon the net tonnage of the qualifying ship. So up to 1,000 net tonnage, the day tonnage income is rupees 70 per 100 ton. From 1,000 to 10,000, the income is 53 per 100 ton. From 10,000 to 25,000, the income is 42 per 100 ton. And from beyond 25,000, the income is 29 per 100 ton. But the tonnage has to be rounded off to 100. And if the last figure is 50 or more, round it off to next higher amount. If the last figure is less than 50, round off to the next lower amount. Okay. I have a small question on this. Calculate tonnage income. Qualifying ship 1, the net tonnage is 1020. So I have to round it off first. The last figure is 20. So I will go round off to next lower amount. So 1,000. Tonnage is 70 per 100 up to 1,000. So rupees 700. Clear? Ship was operated for 120 days. So I'll multiply this with 120 days. The tonnage income is 84,000. If the tonnage of the ship is 8563, I round it off to 8600. First 1000 shall be taxable at the income shall be 70 per 100 means 700, and for 7600 the remaining ton shall be the income shall be 53 per 100. So for 7600 into 53 divided by 100, 4028 plus 700, 4728 daily income. It operated for 70 days. Multiply by 70, the income is computed. Clear? Try part 3. First, I will round it off. 22368. I will round it off to 400. First 1070 rupees per 100. Up to 10,000. 53. 10 to 25,000. 42. So up to 10,000, how much? For first 1,700. For next 1,000. For next 9,000 into 53. 4770. This is the day tonnage income up to 10,000. Beyond that, 42. So 12,400 into 42 divided by 100. 5208. So this comes to 10678 into number of days the ship operated 250. This comes to tonnage. If the tonnage exceeds 25,000, then up to 1,070, 1,000, 10,000, 53, 10,000, 25,000, 42, and beyond 25,000, 29. This way, I'll compute daily income. The ship operated for 100 days. So I multiply by 100. That tonnage income shall be 15,39,500. Clear? Once tonnage income is computed, no other deduction under that PGBP shall be allowed. Neither account of depreciation nor account of any expenses. Okay. Also, no deduction under chapter 6A or setup of brought forward losses shall be allowed. This tonnage income shall be taxable as such. And any losses attributable to this tonnage income, to this qualifying ship, any brought forward losses shall lapse. Okay. If the company has qualifying ship and non-qualifying ship, then the income from qualifying ship can be taxed under the scheme, but income from non-qualifying ship shall be taxed under the normal provisions of the Act. And for this, you have to bifurcate the WDV. So what we do is that WDV in the opening of the year when we opt for this scheme is proportional between the two businesses on the basis of book value of asset as on such date, as used by the business of tonnage taxation or any other business. Okay? The tonnage tax business considers separate business distinct from all other business of the entity. See, this scheme is only toward tonnage income. All other income of the company shall be taxable as per the normal provisions of the Act. Shall be computed as per such provision and taxable as per the normal provisions of the Act. No MAT is applicable on the tonnage income. How a company opts for the tonnage provisions? So a company has to make an application to a Joint Commission of Income Tax within 3 months from the date of its incorporation date. It becomes a qualifying company. Once the application is received, the JCIT shall pass an order within 1 month from the end of the month in which application is received. He may either accept or reject. But before rejecting, he has to give an opportunity of being heard to the company. A tonnage tax scheme once enforced shall remain enforced for a period of 10 years. So once you enter, you have to be there for at least for 10 years. It shall cease to be applied. This option shall cease to apply if the qualifying company cease to be a qualifying company, or if it defaulted in any of the condition of the chapter. Okay. So there are some conditions. A minimum of 20% of the book profit is required to be transferred to the reserve. Training should be given, and that reserve has to be utilized only for the purchase of a ship. So if you default in these conditions, or you yourself said that I want to opt out, or you engage in transaction for avoidance of tax, and in these three conditions, you will be not allowed the benefit of the scheme, and you will not be allowed to again enter in future under the scheme. Okay, up to a maximum of 10 years. If it is observed that a tonnage tax company is a party to any transaction which amount to abuse of tonnage tax scheme, that is, it has given a benefit to any person other than tonnage tax scheme, or it has given a benefit to a tonnage tax company in any other business, then such company shall not be given the benefit of this scheme, and an order shall be passed withdrawing the benefit from such company of this scheme. Such order shall be passed after giving an opportunity of being heard and with the approval of CCIT or PCCIT. And if any such order is passed, then the company cannot again opt for the scheme for at least 10 years. If a qualifying company amalgamates with another company, then such other company can also apply for this scheme within 3 months from the amalgamation. This scheme is applicable, is extended to inland water transportation vessel also, to give them benefit. Okay. It's not, this scheme is qualifying ship may be owned by the qualifying company or may be chartered by. Okay. But for a qualifying company, such company must own at least one qualifying ship. It can charter other qualifying ship. Okay. So this was all about tonnage tax scheme. Okay. You have to remember the definition of qualifying company, the definition of qualifying ship, the slab of tonnage tax income, no expenses or losses are allowed against the tonnage tax income, the procedure of registration of opting in the scheme, and the defaults. And a qualifying company is required to transfer at least 20% of the book profit to the reserve. Okay. If it doesn't transfer, then it default. So it says there is a relevant shipping income 350 lakh, the tonnage income is 180 lakh, and book profit is 400 lakh. Minimum reserve requirement is 20% of 400 lakh, 80 lakh. But if it has only transferred 66 lakh, then the proportionate relevant shipping income shall be taxable. The relevant shipping income was 350 lakh. It has shortly transferred 14 lakh, 80 minus 66 out of 80. So this amount shall be taxable. If it has not utilized the earlier amount transfer in accordance with the reserve, 12 lakh. So it has not utilized 12 lakh out of 92 lakh. So this proportionate shipping income shall be taxable. So 350 divided by 12 into 9. Okay. Now last part of the chapter. Is in respect of tax planning. So first is, if you want to start a new business. Okay. You have to decide about the structure, whether to start as a sole proprietor or partnership or company or cooperative society. So tax provisions implication play an important role. We'll discuss very briefly. You already know everything in other chapters. So for sole proprietor, one, the tax rate applicable to its applicable, which is to the individual, the new and old regime. Second, the salary or the interest paid to the sole proprietor for its efforts or the investment is not allowed as deduction. Okay. But in case of partnership, though it's taxable at 30%, but salary and interest payable to the partner is allowed subject to limit section 40B. Okay. Company, we have a concessional tax at 22% or 15% as the case may be. So cooperative society, there is a special deduction of section 80B. So all this depends the nature of business, the selection of the entity depends upon the nature of the business and associated tax provisions. Lastly, if you purchase some asset, fixed asset, then if you're a company or whatever, no additional depreciation is allowed under the new regime. So you should compute the tax liability under the new regime without additional depreciation, tax liability under the old regime with additional depreciation, and whatever is lower should be paid. Also, if you are covered by business referred in section 35 AD, then it gives the deduction of capital expenditure in 1 year itself. But this 35 AD is not applicable in new regime. So you have to keep all these things in mind while determining the best structure for the business. Clear? So in today's class, we discussed about cooperative societies, individuals, HUF, COP, BOI, tax rates, local authority, mutual concerns, and lastly, the tonnage taxation. I hope the things were clear. In next class, we'll start with the new chapter and revise the same. So for today, we conclude our class with this. Thank you. If you want to see, since we still have some time, there's a question which says that an individual wants to start a business with an investment of 40 lakh. Okay. His wife is actually working, but she will also join the business. And she expects an annual income of 5 lakh. This individual will also expect a remuneration of 40,000 per month and interest. You have to decide which form, whether it should open as a partnership or sole proprietorship or a company as a case may. See, if you open as a sole proprietorship, then the remuneration or the interest payable to him is not allowed. Okay. But the tax rate are concessional. But if he starts as a partnership, then the remuneration or the interest payable to him shall be allowed subject to 40B. Okay. The remuneration flow received by his wife may be clubbed in his hand, but Clubbing shall apply only if the wife is not have professional knowledge or experience. But in this case, the wife has an experience of more than 15 years, so clubbing shall not apply, and the remuneration shall be taxable in the hands of wife only. Okay. So all this we have to write in the answer in detailed form whenever the question asks the structure. We have to discuss what all structures are available and what are the tax implications. In the next question, the company purchased new asset of 10 lakh. His total income without additional depreciation is 20 lakh. And turnover was 3350 crore in FY 23-24. So you have to see whether it should opt for the new or the old regime. See, if it opts for the old regime, then shall be entitled for additional depreciation. From the income, you will reduce additional depreciation of 20%. Around 18 lakh, you will pay the tax at 25%. Why? Because the turnover was less than 400 crores, so tax rate is applicable 25%. So tax come at 4,68,000. Under section 105BAA, the new regime, the additional depreciation is not allowed, but there's a concessional tax of 22%. But then there's mandatory surcharge of 10%. In the tax rate, the total tax liability comes 5,03,000. So for it is better to opt for the old tax regime because in such case, the tax liability is less than the new one. Okay, quite simple question. So we discuss everything what is relevant from this chapter. Now we will conclude our class for today and we'll meet again tomorrow. Thank you. I'll upload these notes and the assignment on the portal for your benefit. Sir, class completed.
Over, sir.
Yes, sir, class completed.
Okay, sir. Thank you, sir.
Thank you.